Good evening, ladies and gentlemen. Happy Saturday to you all. And yes, by the title of the video, you are reading that correct. Jamie Dimon is wrong. I am disagreeing with the famous JP Morgan CEO. And we'll talk more about this in the video, but basically just want to give you a quick snippet of the quote that we're going to be talking about. Jamie Dimon recently in an interview says, "Doesn't find fixed income attractive despite the rise in interest rates. I would not be a buyer of treasuries at 4.2%, nor would I be a buyer of credit spreads at those spread levels." Dimon said at a Barclays conference he wouldn't be surprised to see the 10-year treasury yields at 5.5% or oil at $120 to $150 a barrel. So we're going to digest that later on in the key levels of the video, along with giving you guys the biggest winners and losers, kind of giving our own personal thoughts at the end of the video. All will be timestamped down below. And if you find this interesting at any point, if you could hit the like button, it really helps with the YouTube algorithm out. So just quickly recapping, and this is going to be really key for the key levels part, but before we get into the news part of the video, let's see. The red line is your 50-day DMA. Let's see, S&P below, NASDAQ below, Apple below, Microsoft below, Amazon holding still up, Google, one of the last two remnants out there, Netflix below, Meta below, Nvidia below, AMD resoundingly below, Costco above, and then AVGO. So some of these bigger names out there, you're seeing the big ones like Microsoft, Netflix, Meta, they're all below, along with S&P and the NASDAQ holding down these levels. And it was pretty much a sideways week. Now, what kind of caused that? What was the news of the week? And we did cover this in a bunch of our videos during the week, but we had basically kind of a non-interesting week until Wednesday, where we had inflation come in worse than expectation, 3.7 versus 3.6 expected, previously 3.2 for the year-over-year number, the headline number, but no one really cared about that because the core number went down, so the market primarily focused on that. Month-over-month going up again more than expectations. PPI the same way, core retail sales coming in hotter, so bad data for the Fed, bad data for the Fed, bad data for the Fed, and just more bad data. Like, there was nothing really bullish in the data. However, the market until today, Friday, or basically at the time of recording this video, it was pretty much like, hey, sky is the limit, and basically keep going higher. We basically saw imports and exports coming on Friday. It really didn't move that market too much, but if we take a look at the net speculative positions for the S&P 500, we can clearly see that they are taking profits. They don't want to be the bear fuel that runs us higher, which is quite surprising considering the market is possibly preparing to rip higher. So now you guys have to go jump to the key sections of the video to see what I mean by that. But it's really, there's a catch-22 in this scenario, and I think both teams are getting ahead of themselves the same way like that we covered in the weekend deep dive, or sorry, the week video, that 99% of traders believe the Fed is going to basically pause rates at the next meeting. I don't know what data they're looking at, but we'll talk about it in the debate section of the video. Again, if you guys want to skip to anything, it'll all be timestamped down below. But now Fatal is going to give you the biggest winners and losers, and then I'll be back for the key levels of the video. We're going to talk about that famous quote and a couple things I'm looking out during the week.
This week, the markets had one of the biggest moves and craziest moves that I have ever seen. In fact, you guys can see it right there. You can see starting on the 14th, we had a massive gap up, and then, well, on the 15th, we had a massive gap down. Overall, the week ended down 0.5%, and on the day alone on Friday we had a massive correction where the markets actually fell 1.22%. When looking at the earnings, we really didn't have much. The two biggest ones that I can see here would be Oracle on Monday and of course Adobe on Thursday. But aside from that, there wasn't really anything here that stood out. Jumping now into the heat map, let us see which was the best performer and the worst performer in each sector. Looking into the technology sector, guys, the worst performer here was none other than Oracle, losing 9.82%, and the best performer, it was none other than QCOM, gaining 6.6%. Overall though, very red sector. The communication sector was very green. The worst performer here was none other than Netflix, losing 10.36%, and the best performer was none other than Charter Communications, gaining 6.04%. Taking a look now at the consumer defensives, worst performer actually caught me by surprise. It was none other than SJM, which is actually kind of surprising because I am invested in this one and it's actually reaching my my average share price I bought it at. So this might be an interesting one for me to take a look at again. Now, in addition to SJM, we also had Dollar General losing 9.06%. Best performer overall, though, would be the company Tyson Foods, gaining 4.8%. The healthcare sector was also kind of 50-50. Worst performer here was the company Illumina, losing 7.71%, but also we got the company Dexcom losing 7.6%, and the company HCA losing 6.32%. All in all, though, the worst performer was the company Illumina. And looking now at the best performer, it was the company CVS, gaining 7.64%. The financials are finally recovering, though I have no idea how long this is going to last. Looking now at the worst performer, we got the company CMA losing 6.76%, and by the looks of it, the best performer was PNC, gaining 8.06%. Looking now into the consumer cyclicals, we can see that aside from two companies, everything here was mostly deep in the red. In fact, worst performer was the company MJM Resort, losing 6.08%, and of course the best performer wasn't other than the behemoth Tesla, gaining 10.42%. The industrials look a little bit 50-50. Worst performer here was the company Raytheon, losing 9.2%, and the best performer was the company JB Hunt, gaining 5.3%. The real estate sector, as you guys can see here, it's kind of 50-50, though a lot of them were to the upside, only a few of them were to the downside. Of course, the notable one would be Realty Income. Guys, this thing is under $55. Current share price of $54.10, lost 2.2. However, the worst performer was none other than the company CBRE Group, losing 8% on the dot, and the best performer was the company VTR, gaining 5.29%. Taking a look now at the utilities, we can see that this is all in the green, which is not really surprising. If you guys take a look at the CPI, we did see that the only part in the energy section that was in the positive was electricity. Now, the worst performer here was the company NRG, losing 1.04%, and the best performer, by the looks of it, it is the company Southern Company. Wow, gaining 4.65%. The energy right now is becoming one of the biggest memes once again. If you guys have seen, man, crude oil has just gone through the roof. I think we're past $91 per barrel, which is crazy. I'll probably plop it right here. But you can see that we haven't really seen this yet. Worst performer in the energy sector, it is the company Devon Energy, losing 5.12%, and also APA losing 4.07%. But again, worst performer, it is Devon Energy. Best performer here would be the company OKE, gaining 4.3%. And lastly, when looking at the basic materials, we got the worst performer being Nucor, losing 5.77%, and the best performer, we got CTVA, gaining 5.99%, or essentially 6%. All in all, very kind of mixed market this week, but enough were in the red to bring this slightly to the downside at around 0.2%, as we saw at the beginning of this. All in all, though, guys, I personally think that the Fed will continue to raise interest rates, which we are going to talk about this more in the debate part of the video. But still, though, just be on the lookout because CPI did come out and, well, the market rallied for some reason. Again, we'll cover this more in the debate. Nonetheless, though, this was the market updates. So with that said, take it away, Mike.
So guys, going into the key levels of the video, again, we do this so you guys have areas of rotation during the week. Again, I'm going to sound like a broken record if you guys watch the previous video or basically any of our weekend deep dives in the past 2-3 weeks. And it's going to be, we're getting tighter and tighter. That coil is winding tighter and tighter. We actually saw a nice volume push today on the S&P. So again, that was impressive. You had a lot of selling. Now, it was quad witching. For all those that don't know what quad witching is the S&P, the cash market, the commodities market, and Forex all expiring basically together. So again, we have to be cautious about that, guys. There was a lot of money and manipulation in play, so all this could be thrown completely out the window come Monday morning. So please take this with a grain of salt. However, these levels are always going to be intact no matter what the event is because they are on a technical basis. So again, we had 379.31 for the S&P and 369.15 for the levels that we have to be interested at. And now I'm basically going to turn these previous levels that we had here to white as areas of importance. And again, if we look at the weekly range, we're within a coil of a coil. So we're basically coiling in this area. And I almost want to say that until we break out of our existing levels, that I don't actually see us going anywhere, really kind of giving an indication. So I'm stacking these levels one on another. I highly recommend this because I have seen where we'll break through the previous week's range, but because it's so close to the next week's range that we could get a bounce there. So until we break these areas or volume nodes, I would say, of basically the 369 and a half, 15, then sub 369 would be where I'd be looking bearish on the market, especially because we got this long-term trend line on the NASDAQ and basically this upper area of 378.27. So again, with those two areas, that's where I'd be looking for the NASDAQ, giving my 50-day moving average as my push-pull kind of area where it is now. I think if you cross back above it, there's a 75% chance that you're going to start breaking this upper consolidation here. Or if you just basically continue to crap yourself come Monday, could possibly bounce off the 50, reject off it soundingly, break the lows, then we're definitely heading lower, and I could basically see support maybe finding at the 364.25 level. So how do you make money off of this? Well, simply you could play an option spread that's basically a iron condor on this to capture theta, but I think you're so far into the vent, as I call it, where you're already in this larger consolidation. I just wait for the break of the move. Once we break these outer levels of 379.31 or 369.15, then you just play the continuation of that. I think once you break those outer numbers, then the sky's the limit. And again, I think there's more resistance to the upside just because these levels are closer. You have the possibility to retrace once you get up there, but again, with this breakdown, I think you just keep going necessarily, and I think it's pretty much setting up for the market to do that. I'm really shocked that with this volume that we had here, even though it was bearish volume, we didn't break out of this level, and you had some capitulation of the net speculative position, so it was pretty dang interesting to see how that all played out. S&P is a similar story, guys. 50-day moving average is your range. If we go to the weekly, you're looking at the almost exact same levels for the S&P. So if you don't trade the S&P necessarily, I highly recommend looking at it this week because the levels are exactly the same. So it's going to be a very clear cut of which way we're going to break. We're only about basically 50 cents from the bottom range. So therefore, we definitely could see an easier break to the downside than upside. However, there's more potential to make money to the upside because you're basically looking at 2.34% to the upside versus if you're looking to the downside, you're only going to make 0.17 before you know you're wrong. So again, that risk to reward is more skewed to the upside. And again, it was quad witching, or sorry, triple witching. So again, all that being said, we could easily bounce back above the 50-day if we don't break this consolidation that we've been in. So now, if we hypothetically say this is an A to B pattern on the way up, then we're looking at the 462 level, or if we're saying this is hypothetically an A to B pattern on the way down, we're looking at breaking this trend line at 439.97 on the S&P and heading lower. So again, I don't really think you get any decision until you get Powell on Wednesday, or Powell could completely reverse the move. So keep an eye on that. I could easily see Monday go up, Tuesday go down, Powell kind of decide which way we're going to go, where if we're still winning this range by Wednesday, I definitely be looking out for breakouts. You can play it through options, through straddles, or just playing the direction once it breaks again. Not really going to be keen on trading anything on Monday and Tuesday, just because I'm seeing more bearishness in the market. But then again, I don't know how Powell's going to react. And like I said before, 99% of traders believe he's going to pause, similar to how the ECB was expected to pause and they basically came in and smacked you across the face. So will they believe what he is saying, or are we basically going to get continuation lower or higher? That's going to be the question on everyone's mind. And there's a couple things that can maybe give us an indication of, yeah, that's going to happen. And I'm going to go to Lux Algo just so you guys can see kind of the things I've been keeping an eye on. We are in this wedge, and this is the NASDAQ, that the MACD is separated significantly bearish from one another. Smart money flow is looking bearish. RSI is looking bearish. So I'm seeing a bearish skew, but then again, I've said that due to the bearish skew, until you break this trend line, you have to stay almost on the bullish side because the bulls have been rescuing you every single time. Similar story to the S&P with a wider range. So tech is going to give you an indication, but I think S&P is going to kind of give you the hint beforehand. So again, MACD is separated from one another, but easily kind of consolidate and reverse at this point. I'm going to keep an eye on that right now. I'm not playing the directional move at all. I'm not actually playing any move at all. But again, until the ranges break or this wedge breaks, that is what I'm going to decide on. And whatever way it breaks, that's the way I'm going until we get a retest of that trend line and break upwards or downwards, depending which trend line we break. So you guys can simply draw this out very easily. If you just go to daily right here, adjusting that line real quick, you can see that we're in a tight consolidation there. We went up, nearly touched the top of it, got rejected back down, and now we're coming down to this trend line. It's a pretty simple play if we look at it. If we look at the weekly, you already see you were crossed back here. So again, when we had the Finch downgrade, we pretty much set up this pattern. Now this could be a pendant flag basically going to the upside, or a big M forming here. We're not really going to know which one it is. However, by the close of the week, we got a bearish flip on the smart money flow. So I'm more looking at Powell to come out to give a more hawkish speech. That is my expectation. However, my expectation and reality are two different things, and we have to see how it all plays out based on the levels given here today. But jumping over quickly to VIX, dollar, and yields, this is where we're going to get really, really interesting. I basically said on the Friday video that VIX was breaking this area here and that I basically get out of my position. Yeah, I got stomped out of my position for a small loss this week. However, VIX did hold this level, massive push up, does have the momentum to continue. Do we get a nice VIX spike? That's going to be the question that everyone's going to be asking. And I think you don't really get that answer until Powell. Now, I could be, again, like I said, completely wrong, and we could keep pushing or dumping until Powell. But Powell is going to be your deciding factor of what the longer term trend is going to be. So right now, the market's kind of teeter-tottering between where it kind of wants to go. Case in point, fear and greed sitting at 52. So again, all these things are basically indicating there is indecision and coiling energy in the market. Where it breaks, you don't want to be on the wrong side of that. So again, please keep an open mind. The dollar, I said that I was looking for this trendline retest at this apex where the 50 weekly moving average. Right now, the dollar has no desire to go down whatsoever, not even touching this trend line, and daddy oil is going higher. However, we're going to cover yields first before we get into that, and to bring back Mr. Dimon's quote. So let's go to the 2-year, just kind of indication. So you got 5% on the 2-year, 1% being 5.4%. And when he talks about the 4.2% number, he's really referring to the 10-year yield. So the 10-year yield is basically what he's referring to as the 4.2%. And the reason he's referring to that 4.2% is because that's what the 10-year, what banks traditionally trade. They borrow at the 10-year and lend at the shorter term interest rates for higher percentages. So right now, this quote was given around the 4.2 mark. So around this area here, right here, where we're basically forming this area of consolidation. Now we could be easily setting up a massive, if we go to the weekly view, a massive basic W forming right here that could easily break out and the rocket ship to ignite again. And that rocket ship is what actually launched us into this bottom area right here, where we did form the W right here, where we created this massive run up in the yields along with the previous run right here that we are currently in right now, if TradeView would cooperate with me. So again, we got that W here. We're nearing the double top right here. So again, this all is setting up to be very, very bad for yields in the sense of the bond market. And I don't think banks, and him being a CEO of a bank, I would agree with him that you don't necessarily want to touch the 10-year. However, I would disagree with him, and this is where my disagreement comes in. Why are you not participating in the 3-month or the 1-month yields, where you just can keep rolling this 3-month, 1-month to continue drive your income rather than losing it to inflation? And it's basically free money. It's a guaranteed risk to return. You have a set profit margin. You have zero risk because of the government. So if the government defaults, you got bigger problems. But churning this yield right here, just rotating a 3-month or 1-month or a 6-month, even in a retirement account, would basically continually allow you to take advantage of what the Fed is giving you, kind of giving you the liquidity to keep rolling to adapt to the environment. And that's what I've been doing in my 401k at work, where I basically just keep rolling into 3 months, and it's been doing pretty good. Just free 5.4% for me checking my portfolio once every 3 months. So again, kind of easy money there. And that's why I really disagree with him when he talks about this quote that 4.2% is not attractive. Yeah, if you're borrowing 4.2% when you're expecting this massive explosion in yield, then yeah, that wouldn't be attractive to me. However, I'm not basically bugging down for 4.2% for 10 years. I'm bugging down 5.4% for a short amount of time. And again, his $120 to $150 oil projection, we got to take a look at oil real quick. And it's basically boomtown, baby, where we had a hammer style candle on the day, but really it's not even a hammer style. It's not even a hanging man. It's just a strong move up. Bulls defend the low. So this is what you really wanted to see from the stock market, but not really. You're just seeing oil going higher, $91.71, the high of the day being $91.19, the closing right at the high within 2 cents of it. So this can easily continue if you own any oil stocks or anything that's correlated to oil. USO, where we can actually take a look. USO previously was around the $60 and now it's $81. So nice $20 push, giving you basically a gain of 35%. So congratulations to anyone that bought that. And again, right now oil is on an absolute tear. I do believe that $95 prediction will come true probably sooner than I thought and most of us thought in the market. And let's see what other structure oil can set up for maybe another massive A to B pattern. I'm sure this leg right here, once it has its pullback, it's going to go much higher, and we'll see how that all plays out. I'll make sure I keep you guys updated on that. But now we're going to quickly jump into the news for next week just to see what we got on deck before we talk about the debate. So going into Monday, you really got nothing. Tuesday got building permits and housing starts, so you'll see how the housing market's holding up. I expect it to basically stay the same, come in line or slightly better. You're not really seeing weakness in that sector, especially with the CPI reports where they're coming in stronger than expected inflation in that sector. And then crude oil inventories, nothing really on Wednesday until 2 o'clock on Wednesday Eastern Standard Time, where we have the economic projection. We get an SOP this meeting, so we're going to basically see what the Fed members are thinking. That's going to be really, really important for longer term interest rates, and they're expecting a pause, which I don't think you absolutely get a pause. I think you get 5.75%, 25 basis point hike, because none of the data is pointing to where the Fed is capable of holding down inflation. So if they choose to lose their credibility, that may happen. But again, we'll be covering that live on Wednesday. So make sure you guys subscribe to the channel so you can get notified that, and make sure bell notifications are on. And Thursday, continuous jobless claims and no-show jobless claims, like always, along with Philly Fed Manufacturing Index coming in basically zero, so that's yikes. Are we going to start entering contraction territory there? And then Friday, as always, in that speculative position. So not really much to talk about except the interest rate decision, and I think we've pretty much extensively thought about this on the channel, and we'll just kind of give you guys our quick unadulterated thoughts, and then we'll go on to another topic. So I'll let Fatal go first of what does he think Powell will do. Remember, we get a summary of economic projection in this meeting. It's an SEP. What is going to happen with that interest rate decision? Your turn, sir.
This is next week, right?
Yep, next week on Wednesday.
So this is the FOMC then.
Yep.
So FOMC is on Wednesday.
Yep.
Oh boy. Oh boy. I think we're gonna get an interest rate hike.
Okay.
A basic 25 interest rate hike, which, I mean, seeing that these people think that there isn't going to be one, if it does come out to be one,
well,
yeah.
would you like me to hold your beer for a second?
I don't drink, but you may.
Yeah. It was 99 yesterday.
Wait, what?
Yo, no, they're going higher after seeing this data.
It went up?
Yeah, you know,
it was 97.
Yeah, it was 97, went to 99, went back down to 98. So, but really, we're arguing semantics between 90, 91, 90, all the way to 99. Shit, it can be 100 at this point. And
I guess.
I think they're wrong. I think they are so high on their own supply, they don't see the
but where is this coming from?
So
but where is this coming from?
So the way the CME tool is determined is they go and they pull economists.
No. That's not what I meant. I meant, where is the idea that there isn't going to be one coming from? That's my question.
No, come on. You should know the answer to that. It's the same way that Powell's going to cut now, 3 months ago, that Powell's going to cut in January, the Powell's going to cut in February, the Powell's going to cut in June, July. Now we're seeing cuts in July of 25 basis points. Let's see what else is there. That they're not going to hold higher for longer, that stocks only go up, oil's not going to go to 100. Like, shall I keep going?
Okay, fair enough. You made your point. And that's why when this thing actually comes in and they do increase it by even just a mere 25, man, I foresee markets falling and then instantly recovering, because that's just how things are right now.
I don't think the 25, even if they get a 25, that jolts them. I think because they're in this little bubble of expectations, right? So like they're only expecting, if you go to December, they still have like, they'll ration in their brains. Oh, we were wrong. That 34% was right, and then they'll pause now, right? Until CPI rips your face off.
But what you're looking at right now is December 13, 2023, the expectations.
Yes.
People think that they are going to keep it the same.
Yeah, so December is where it gets a little more, let's say, trickier per se, where the people are saying maybe they got one more hike in them. Because remember, Powell hinted at 2 hikes back in, I think it was May, is when they hinted at the 2 hikes, and they basically did a pause hike, and then everyone said, okay, after this hike, we're not going to raise rates. And Powell, they've been data dependent. Well, the data's saying you got to hike, but the market's not really believing it. But I don't think that's the important thing here. The hike, because it's meeting to meeting, they're talking about hike, not hike, hike, not. It's a very convoluted thing to focus on. I think the SEP is what's going to get them. I think the interest rate decision comes out, it does a spiky thing, blows everyone's stop to the top, blows everyone's stop to the bottom, and then it kind of goes sideways into Powell's speech, where you're going to get the SEP. The SEP is, if you start seeing more participants going to a higher than 6% rate, because you had one person there that retired now, that we all know was Bullard, saying higher than 6, where he's no longer going to be on the Fed anymore.
I didn't know that. Okay.
Yeah, Bullard's retiring. So if you see more people trending towards that higher data point, you are going to see a shock in the market, because that's truly a shock. They're not expecting these doves to flip more hawkish. And we actually been seeing that recently with the data coming in, and everyone, like, when they're talking publicly, they're talking like, oh no, we can pause rates here, like, just talking the talk. But when they get in a meeting and we see the meeting minutes, it's like all participants agree that we should hike. I'm like, wait. So
are we going to get the dot plot in this FOMC?
Yeah, that's SOP. That's summary of economic projection. That's the creme de la creme.
Are we live streaming then?
Yeah, I'm definitely
good. Yes, absolutely love it.
I'm not going to be a pleb.
Oh, thank God. So I actually want to mention 2 things and this is in regards to all of this. The first one is that, remember the first time, well, I guess you could say the inflation is transitory kind of thing, right? What was the leading factor? Yeah, what was the leading factor to that? Remember?
I actually don't know. I don't remember.
Energy.
Oh, okay. They thought energy would calm down.
Right. So you saw energy during the inflation's transitory period, energy just going through the roof, right? And what are we seeing right now?
Same thing.
Energy going through the roof. So this is why I'm just like, I don't think that they're going to pause or even cut, because they already went through the inflation's transitory period when energy was spiking. And what are we seeing now? Okay, inflation has gone down, at least the headline inflation has gone down to around 3 at the trough. But what are we seeing now spike again? The same thing that was causing the inflation to go up during the inflation's transitory. So this is part of their ego as well. That's all I wanted to say. So just keep that in mind.
Their egos are bruised. Their egos are bruised from that. So they're going to aim more towards we got to keep our credibility.
Yeah, and the second thing that I want to mention is a comment that we got on the video for the ECB hikes.
Okay.
And this was Y1. You may just want to plop it in here, Mike. I don't know if you may want to do that. So we got Y1, the big Y1. We got, I have a question for the group here. All right. What is the most direct way to speculate on the Fed's announcement if there is going to be a rate hike or not? I know technically just something like SPY can work sort of, but we have seen the market react weirdly to news a bit too much for me to consider it directly correlated. To see it as a directly correlated way to speculate on interest rates very short term. Is gambling site really the only quote unquote pure way of betting for or against interest rates going up next week? What about bond futures? Have you seen more correlated responses with different tracking instruments you can use to speculate? So I'm actually going to say this right here, man. If we knew what the Fed was going to do, we would be millionaires right now. If we knew how the market was going to react based on this, we would be billionaires right now. Because the fact of the matter is that we have seen the Fed increase rates, and the market goes up. And you're just like, what? Inflation goes to 3.7 and the market goes up the following, like that same day. So unfortunately, I have, or I don't, Mike, maybe you know, but the way that I see it is no amount of fundamentals, no amount of technicals can show you, or can at least with anything higher than like a 70, I don't even think you have that. No amount of anything could, and I wouldn't say guarantee, but tell you what the market is going to do. Because in the short term, the markets are a voting machine, right? Stocks are a voting machine. The stocks that go up are the stocks that are popular. In the long term, and by long term I mean, 10, 20, 30 years, it's a weighing machine, right? That's where the fundamental comes in. So what are you going to say to that?
So with the Fed, it's really going to be, are you above the 50 or below the 50? That's going to give you the direction. And then playing the Fed is a horrible idea in its sense, because why do you want to guess what the Fed is going to do? I'd rather just wait and then make money on whatever direction the market breaks. Because in the key level section, I mentioned that you're coiling now. You're coiling and coiling and coiling on the market. And basically that means that once this coil breaks, and you're getting tighter into this coil, that when this thing breaks, whichever way it's going to be, you're going to get a massive explosive move, probably a nice 5-10% rally off of it, or 5 to 10% dump. Me seeing this was quad witching on Friday, so a lot of this is to do with expiry. $3.4 trillion expired. They want the premium. So they consolidate in this area, and usually after quad witching, we get an explosive move outwards, upwards, or downwards. I think, like I said, it's going to be sideways into the Fed. I don't think you get the move. If you get a move, I think it's a false move, because moneymakers are basically going to try trapping people on the wrong side of the trade. And I think the Fed is pretty much, at this point, Powell either has two options. He has to do a Jackson Hole style speech, or he lets the runaway train basically run him over. Because if they don't come out and be more aggressive, because like you've seen what the second they took their rhetoric off of, we're going to keep hiking, we're going to keep hiking, we're going to keep hiking, you're seeing a slowing of energy basically decreasing, right? So the second Powell stopped saying, like, being super hawkish, what energy do? Stopped going down, started basing out, and now is going back up. So he has to jack the rhetoric up.
Sure, but I mean, energy alone could be explained by other outside factors. But I see what you mean, though.
Yeah, but the thing is, it's all energy prices are always determined by how much someone is willing to pay. Even though there is a lower supply, it is how much someone is willing to pay for that. And if you know that you can dump your money in, for example, if everyone's going to the commodity sector because it's growing 30% on a 3-month basis, or I can get a higher paying, let's say 1-year yield that's basically paying me 5.4%, and I'm making, or the yields is a safe bet, right? If you make the yield markets more attractive and keep rates going up, we have the 10-year basically ready to break out right here. And if it breaks out, it's got all the fuel to go, and we got the W forming. Everything's primed for a nice rip to the downside. Do you get that? Powell really has to crush the hopium. He has to come out. I don't think he's learned his lesson the last 3 times. He basically has to come out and give you Jackson Hole 2.0. I would even say worse than Jackson Hole. He basically has to come out and say, we are not cutting rates for the next 2 years. Get it through your thick skulls. Yeah, so to answer your question, Y1, this is why I don't... we like to speculate whether or not the market will... we like to speculate whether or not the Fed will increase interest rates. However, we have seen more than one time Fed increases interest rates and the market goes up. Seriously, we have. So it's like there is no way to directly know this. It's like impossible. So that's why I'm just like, FOMC comes out, we'll make a video about it, but take the opportunity. If the market falls, take that as an opportunity. If the market rises, well, you can still have opportunities right there too. So, but determining what they're going to do, the only way to do that is if you're Jamie Dimon from JP Morgan, and you could call him up and be like, what are you going to do?
That's like the only way.
He's actually, and like the title of the video is Jamie Dimon is wrong, is because he's saying fixed income's not a good idea. I'm like, I would disagree with you, sir, because that 1 month rolling is pretty lucrative right now. Now he's expecting, and if you read between the lines of what he's saying, he's basically expecting the Fed to come out and be like, 25, 25, 25, 25, just wrecking the market because he's basically saying at a 4.3 on a 10-year, right? That's what the banks look at. That's not attractive to him. So what's he expecting? Like 5.5?
Right.
And that's what he's saying, based on the quote that I presented earlier, is he's expecting 5.5 on the 10-year. Do you understand that means the Fed would have to jack rates up another 1%? AK, look at the SEP. Look at what they're saying. If they continuously keep increasing their SEP projections, you can play the treasury yields to continually go up so you can maneuver properly. Now, like we said, how the market reacts, that's up to the market. The market, like for a short term, is a voting machine. However, if we're talking the 6 month to 1 year approach, seeing how everything's basically falling apart and breaking, you can just sit on the sidelines, honestly, for the next couple months and roll into treasuries, honestly. Like if you just don't want your money to lose to inflation, just sit in 1 month treasuries and keep rolling them over every month. It'll be a lot less stressful for you. And when
you also have a higher yield.
Not even that, it's just you just keep rolling it, right? So until the yield train breaks, yes, you're not going to get returns as much as the S&P and NASDAQ. S&P and NASDAQ could go up 20% tomorrow for all we know. The problem is they can also dump 50% on the same token, where the yields are going to be, I'm paying this amount percentage on a yearly return per month. Here's the amount. You know what you're getting into. You know at 1 month you're safe because 1 month, 3 months, 6 months, the expiry is you can hold it to maturity to get that yield. You're not going to be at the 10-year waiting when the bond market's completely upside down. You need that money. You have to sell it for a loss versus you can hold to maturity. And it's just simpler. That's what I've recommended to like everyone in my work. They always ask me about what should we do? What should we do? I'm like, treasuries. Oh, did I say treasuries? And if you want to buy crude oil, that's not a bad idea.
Or at least any energy company. Yeah. So is there anything else that we want to take a look at?
So now I got the CME tool. Now got to poke a little fun at Finch. So, Finch downgraded the U.S. debt. However, Finch affirms Germany a AAA rating as Germany is in a recession.
Wait, what?
Yeah. When you think they're full of crap and then they prove it.
So Fitch Ratings affirms Germany a AAA, outlook stable. But what? It's not how. Not only are they in a recession, you also have the whole Russia thing with Ukraine and the oil thing. So it's like, what is this?
And here's the thing. They're not being hypocritical. At first glance, they look like they're being hypocritical, but they're comparing. The rating is always a comparison between all the other countries in the world. The U.S. has a spending problem. It is running out of control, and the liquidity in the bond market is getting worse. Which, if I show you this, what does that look like?
Boy. The reverse repo.
No. Look here. Look at the acceleration. It's not going the right direction. You see the slope here, pause, slope even further, and now we're just like in free fall. Yep. So now this is a couple data points, so we have to see how it all plays out. But if we start seeing this day after day after day after day, we're at 1.4 trillion. That 1 trillion mark's coming up pretty close. If we hit that before December, we got a lot of problems ahead. And so to answer my one question, keep an eye on this.
So this means that there's a lot more liquidity getting pumped into the market because people do not want to hold treasuries anymore.
Well, it's yes and no. So people don't want to... So the government has to inject this liquidity in order for themselves to borrow. So the person that's actually consuming this liquidity is the U.S. government because they are a seller of treasuries. They have to go out, sell the treasury in order to get that cash to fund their liabilities. So what they're doing is by selling treasuries, they're driving the yield up. They're using the reverse repo to then drive said yield back down to where it is or keep it stable. But the free market is still saying like, no, we still want nothing to do with you at 4.3.
Right. That's what I was trying to say.
Yep.
That's what I was trying to say. So that's really, you can just see that little end right there. That's just like almost a straight line down.
Yeah, we covered this on the stream, right? Or no, sorry, the video.
The stream,
the day
the video.
before, we were at 1.492. $92 billion in one day go poof.
$92 billion gone in one day.
So literally, if the rate of this slope, right? If this slope continues. By the end of next week, we will be literally what? We'll be at a trillion. We'll be at a trillion.
Wow.
So it's gonna get accelerating, right? So as everyone knows, come on, like everyone that trades the treasury market is the biggest market in the world. They can see the writing on the wall. This is all public information. So they're gonna be like, I don't want a 4.4% yield. I want a 4.7 because they know the U.S. government is a proverbial money drug addict that is
spending drug addict.
Spending addict. Yeah, it's a spending addict and everyone knows it. So they're gonna take advantage of you.
Yeah. Absolutely. It's like why bother now with a 4.1 yield when I just have to wait a week and just get a slightly higher yield? I love it because it's what's happening to them is the excuse as to why we can't be in a deflationary economy. Because why would you like if we have a deflationary economy, you wouldn't want to spend money because then you could just wait a week and then things will be cheaper. It's just like, right, but you also have to buy food. So it's like, but with these guys, it's like they're literally in a deflationary spiral, causing yields to go up, and people don't want to buy the current yield because if they just wait a few more days, that yield's going to go a lot higher in just a few days.
Yep.
So,
and one of my favorite sectors to indicate when the end is near, and I mean, like I'm finding like a grim reaper every single day. It's like it's insane. So this is XHB home builders. Home builders usually predicted the 2008, the .com, everything. It predicted all of it. So in 2022, what happened? Massive top and, dumped all to new lows in October. I'm going to show you the graph now.
Go on. That's exactly the same.
It's literally a double top to a penny.
Literally like the exact same number.
Yeah, it double top to a penny. And then broke the 50, right? You break the 50, reject off 50, break 50, reject off 50. What do you think comes next? Oh, and you're on the FOMC meeting week. So it's like, come on, guys. Do I really have to paint the dang picture where we're going next?
Yeah. And
here, I'll paint it for you. Doink, doink, doink.
Yeah. And, how is the market reacting to all of this? Can we take a look at the fear and greed?
Oh, fear and greed, classic 52. But they can't make up their mind.
They can't, no. I mean, so during my segment of this video, when I took a look at the 5-day, dude, it looks like Devil's Tower in Wyoming. Like, you look at that kind of movement, you're just like, gap up, then gap down the following day. And it's just like, what is this? So, yeah, it's not surprising that we are in the neutral because at this point, we have no idea where we're going right now.
Yep. And again, quad witching. So we have to see where these levels go out from here, the 50-day. Right. It's kind of like one of the YouTubers I follow was talking about, like, he's confused as all daylights because he's like, you're just violating the 50 like it doesn't exist. Like, up, down, up, down, up, down, up, down. I'm like, yeah, I agree with that. And again, the 50 is kind of like a pulse indicator, I would say, like bullish pulse, bearish pulse. But we have to see how it all plays out because Daddy Oil doesn't look like it wants to stop in any way, shape, or form.
Yep. And then on top of that, I'm also taking a look at the technology sector. Dude, it bombed. Bombed
XLK.
hard.
Let's pull up XLK.
Yeah, pull up XLK for a second.
And this is like, if you really want an indication of where we're going, here's your A to B pattern. Completion 159, no price structure. Once you break basically 162, which is the low here, you confirm that pattern, and Bob's your uncle. That's where it's going.
Yeah. So that'll be very, very interesting to see. And I think that's pretty much all we got for you, right, Mike?
Yeah, so we got overnight repo we covered, the CME tool. So throw it down in the comment section below, guys, of do you think all these people are on crack, cocaine, a mix of the both? And is Powell going to give them what they want? Or is he basically going to come out with a hammer and drive it through their heads?
So basically, translation, are we going to get a 25 basis point hike on Wednesday or not? Anyways, guys, that pretty much does it for this video. Y'all can follow us on the new tech sites. Link is in the description below. Make sure to like, subscribe, comment. Really does help here on YouTube as well as Rumble. So with that said, peace out, and we will see you all next time.